In retirement, there are many different strategies that you can employ when it comes to how to withdraw from your retirement accounts. Now, you do have Social Security. You have your retirement accounts that you've been saving into all of these years. You may have some real estate, and you may have some savings accounts or some brokerage accounts that are not retirement in nature. So each one of those are different tax strategies that you can employ. And if we can cherry pick from them, what we can be doing is actually starting to decrease your amount of taxes that you owe and increase the likelihood that you will have a successful retirement just by starting to cherry pick which buckets we take our taxes from and how we take the income. What we want to be doing today is talking about that income and specifically tax-free income that you have available to you. Hey there, it's Nathan Krampe, and I create these videos because you are likely very ambitious when it comes to your overall wealth plan. Do me a favor. Click subscribe right here so that you can be notified of future videos that are going to help you with that wealth plan. Today, what we want to be doing is talking about your overall wealth plan as it pertains to income. Now, specifically income in retirement. And there are different buckets we can be going down, but we want to be cherry picking the tax-free income and how it can be benefiting you in the future. There are a couple different types of tax-free income and strategies that you can be utilizing in retirement. Now, the tax-free income sources come down to the Roth accounts, some life insurance accounts that you may have, as well as some aspects of real estate. Now, what I want to do is touch on each area of those so that you have an understanding how they work and how you can be using them in your process so that you can be lowering your taxes not only today, but then how we can be planning for taxes in the future so that you can actually have a better retirement. Now, that's the hope. It's obviously not a guarantee, but if we can be looking at the different sources of income, where they're coming from, whether they're taxable, tax-free, or just a tax-deferred element, we can really start to pick and look at the different elements on a year-to-year basis to figure out which ones are going to be best suited for you to take from. So let's dive in. Well, what we want to be doing then is taking a look again at tax-free income sources. I want to start with the Roth accounts because that is what we generally know when we talk about tax-free accounts. And just by nature of getting it out there, Roth accounts are such that once the money is in there, they grow tax-deferred. So you're not paying taxes on a yearly basis on all of that growth. And then when we take the money out of the accounts, it's tax-free. Now, yes, there are a couple stipulations just with that, but for the most part, just understand the concept that if we take money out of the Roth accounts, whether it's a Roth 401k, Roth 403b, and even a Roth IRA account, generally speaking, it's going to be tax-free if we meet all of those criteria. Okay, so when we dive into that, we have money in the Roth accounts. And for some of you, this would mean that maybe you have a Roth 401k piece. So you have your traditional 401k and you have your Roth 401k. So the money that is in there has been put in there on an after-tax basis and now has been growing tax deferred, and we can be using it tax-free for retirement. Now there's the other bucket as well, the Roth IRA accounts. Now you may or may not have had the ability to contribute to those Roth accounts just based upon your income streams. Well, good news for you, there are still opportunities that you have to put money into those accounts. So one idea is if you're still working, you can do a backdoor Roth. So that's where we put money into the traditional IRA while you're still working. And since it is you're over the limits of the income as well for the Roth, you'd be over the limits of a tax deductible contribution to a traditional IRA. So we actually won't be taking those deductions. So it's a non-deductible IRA contribution that we can actually then roll over into the Roth IRA to get money into that account. Well, this is also in addition to the Roth 401ks, your retirement plans that you have that you can be directing money towards as well. So there's a lot of strategies and ways to get money into the Roth accounts as you are working. Now, in retirement, it's a little bit less complicated. Obviously, all we need to do is just say, I'm going to be taking money out of these accounts. You can take it on a one-time basis, and you can also be taking it on an ongoing basis. Now, with your employer, with your 401k accounts, your retirement accounts there, they may not like it that you're switching from a one-time to a reoccurring basis, so they may only give you a couple options for what to do. But once we have the strategy set up where we're taking a reoccurring amount, we can make sure that that is part of your overall wealth plan by obviously checking on a yearly basis where you're going to be at for taxes. You see, when we take a look at tax-free income, that's the great nature of it. But we want to take that when you're in a higher tax bracket. We want to take more tax-free income the higher the tax brackets are that you are in. So if you're going to be in the 24 or the 32 or even the 35% tax bracket, well, then we can start cherry picking money out of the Roth accounts, and that's going to help to keep your overall income as low as we possibly can. Well, that's a great strategy. So when we take from those accounts, obviously that's going to be very beneficial to you. But there's more than just the Roth accounts that I want you to be aware of. You see, you may have life insurance as well. Or you may have the desire to start leaving a legacy and needing more life insurance. Life insurance can be used for many different strategies. Now, one of them is obviously transferring money to your children, and that can be tax-free to them as they receive it. That would be taxable to your estate, but could be tax-free to them. So this is a great way, obviously, to leave a legacy that you would like. And when you start to do that, you start putting money aside for them. It doesn't necessarily all have to be put aside just for your children or your grandchildren. You see, you're going to be building up on a permanent policy what's called a cash value. Now, whether you have a whole life policy, a universal life policy, a variable universal life policy, it goes on and on of the list of what types of policies you could have. But all what they have in common are coming back down to that cash value, the accumulation of the cash that's there. Now, some actually increase the death benefit with the cash value, and others are level and they will be having an additional cash value that's paid kind of into the policy, but it's not going to increase the overall death benefit. So it depends on the type of policy you have too, just of what happens there. But here's the thing, that cash value is very useful. Now, what you can be doing then and how you can actually be using it for a tax-free income is by the way of taking a loan out of those accounts. So when you take a look at your policy, let's say we have $100,000 that's set aside in your overall life insurance policy. Well, that can actually now be used and you can start taking a withdrawal of the policy itself. Now, while the policy is still in force, still active, you're taking a withdrawal out of it. Now, that loan that you'd be taking, and it has to be a loan to make sure that it's tax-free. If you're just taking money out of there, it actually could be subject to tax. So the whole idea then is that the insurance company is saying, well, at some point in time in the future, you may be paying this back. So there will be a slight amount of interest that would be owed on the loan of this policy. But here's the nice thing. As we start taking money out of the policy, that's tax-free. And if we start doing this correctly, the idea is that we never run out of money in the cash value portion of it, because if we do, the policy may lapse, or they're going to talk to you about putting additional money into the policy to keep it in force. So we don't want to do anything to hinder the policy. But that cash value that's in there can be very useful because of the fact it was saving money over the years. It was growing tax deferred as we were putting money into it and having the growth. But now we can start using it as a tax-free loan that you can be using for income in retirement. Now that is the key aspect here. Those loans are going to be very helpful to you, and we may not want to repay them. we may want to have it so that it's going to be paying over the course of maybe 20 or 30 years of your retirement. And if we do this correctly, we're never going to run out of money in the policy itself, that cash value piece, which means we're going to save the overall death benefit for, say, your children or your grandchildren, passing on that legacy. But now you get to use the cash value today for tax-free income sources. Now there's one other idea that you can be thinking about here as well, and it comes to charity. You can be putting money aside for charity in the exact same manner, and some of these policies then could be saying, well, I'm going to direct the overall death benefit to charity, and then I'm going to have the income directing to myself as well as we're going on through the years. So there's many different strategies, many different ways that you can be using life insurance, not only to leave a legacy, but as well as for income. So we have the Roth IRA that's there, we have the life insurance policies that are there, and then the other aspect that you could be looking into is the aspects of your real estate. Maybe you actually have a rental income property that you have, and some of that money that you've been putting into there may be what's called a return of capital. Now, if that's the case, that there's income coming out in the form of rent checks or interest, things of that manner, that may, and this is where you're going to have to talk to your accountant about that, your tax advisor, that may actually be a return of capital. And the return of capital is tax-free. So this usually would go in a pro rata basis, so maybe that some of it would be tax-free and others would be taxable. But what you can be looking at then is how to take money out of your real estate correctly so you can actually use it for retirement purposes. So we have the three different buckets, whether it is Roth accounts, whether it is insurance with life insurance, or whether it is real estate. All of those can come back to help you in retirement to keep your taxes lower. So if we do that, we take a little bit out of the tax-free bucket, we take a little bit out of the taxable bucket, and we take a little bit out of that what would be the tax-deferred bucket in part of your retirement plans. All of that can be helpful to lower your overall income. So look at where you're at today with the different accounts you have, the different ways that you have saved over the years. And I bet you can start to put together a strategy that's based upon each one of those and how to take money out. Now that strategy comes back down to your taxes. So this is not a set it and forget it type of a strategy. This is something that we have to look at every single year and put a plan in place. So if you are actually going to be taking more of, let's say, some stock options that you have coming due, that's all taxable. That's ordinary income. Well, we may want to take a little bit more from the areas that are not going to be taxable for additional income then. So maybe we want to take from the Roth IRA account that you have for additional expenses in the year. That may help to lower your overall taxes. Well, if we do this on an ongoing basis, start to plan for those different areas, we can start to look into whether we have a high tax year or whether we have a tax cliff, and for whatever reason, this year you may not have a lot of taxable income. Well, then we can start making strategies. How can we shift more money into the tax-free buckets? All of that can be done just by knowing where your taxes are. So there's strategies for all of this that we can be going down here, but just take a look at your overall forms of savings, where they're at, be looking at the types of retirement accounts that are tax-free, like the Roth IRA, Roth 401k. Take a look at your life insurance. Maybe it's actually such that you want to start utilizing that. Or maybe take a look at the real estate that you have as well and how you can be receiving some income off of them. All of that comes back down to the strategies you have in place to help lower your taxes in retirement and help to improve the quality of where you're at with the income that's coming in, how much you're paying in taxes, and the satisfaction you're going to have in retirement. Because you've made it this far in the video, I want to celebrate you. You see, most people talk about putting together a plan in place for retirement, but they don't actually follow through and put that plan in place. But I know you are different. You want to not only put the plan in place, but look at how to implement that plan. That's where I can come in and help. Click the link below, and I'm going to offer you a special one-on-one consultation so that we can be talking about your overall wealth plan and how it pertains to income streams in retirement. Now, this is going to be a great avenue and resource for you so that you can be looking to improve your overall wealth plan. Click the link below, and I look forward to seeing you soon. For more tips and tricks on how to improve your overall wealth plan, click on this video right here.